we have a treat for sure. I'm sure the listeners have heard Larry Pesavento and his friend John Jameson. They did a great workshop last month in October for subscribers to Fibonacci 24/7.
Okay.
And I've chatted with John a few times myself since then. He's got a lot of great information. I said, you got to come on the show, man. Talk about kind of what you're talking about when you're looking at the market. And I think they're going to be putting together a workshop as well coming up this month, middle of November, for subscribers as well. We want to welcome back John Jameson to TFNN. Morning, John.
Hi, John. How you doing?
Yeah, hi guys. How are you? Yeah, hi Tommy. Tom? I'm good.
Good to talk to you, man. How's everything going?
Yeah, good, thank you. Yeah, very good. Very good. Good to be on.
So, you know, of course, in the den, they've heard about John. You know, Larry's talking him up for last month's workshop. You heard about him as well. And if anybody didn't get a chance to check it out, you can still sign up for Fibonacci 24/7, get that great archive. I actually watched it twice myself to get all the good information. But John, so tell us a little bit about yourself for some of the listeners, you know, that weren't in the workshop. I know you're over in the beautiful Isle of Man over there hanging out. And so tell us a little bit about yourself, man, how you got into trading, how you know Larry, and how you came across.
Sure.
Yeah.
Sure. Yeah, well, actually, I got into trading as a happy accident. In the 1990s, I was running a IT consultancy business, and I basically sold up in 2001, and during the summer of 2001 I was swapping my assets over into Aussie dollars, and in August 2001 I moved to Australia. And over the next few months, probably about 2 years, I was noticing just the amount of difference it was the amount of difference it was making against the Aussie dollar appreciating against the British pound. And so the key here is that the actual timing of the swap over of the money was a complete and utter fluke. So anyway, I was hooked, and then I spent quite a long time trying to figure out what I actually did, because at the time I literally
those currency conversions are pretty intense, John, aren't they? You know, in the United States, we didn't learn a lot about currency because, you know, there's so many states. Do you know what I mean? But when you guys are overseas, your countries are like states.
It's a real life deal.
It really is, and it's like, wow, a lot can be made and a lot can be lost very quickly. Yeah.
Oh, sure. If you're moving your major assets around, you're moving, you know, lock, stock, and barrel to another country.
Sure.
It makes a very big difference what rates you get. Absolutely, it does. Yeah.
Yeah.
So, John, for the listeners, I know we chatted a lot, but you know, when you're looking at markets, right, just maybe a brief, before we get into, because I know we want to talk about cryptocurrencies and Bitcoin, man, great time to be talking about it, right? Seriously, I was talking to John yesterday. But what are you looking at in markets? Maybe just a brief of what you went over, just the way, I love the way you look at things in terms of probabilities and the simplicity of the way you're looking at markets, and kind of just what you talked about a little bit in the last workshop you did with Larry. Sure.
Well, thank you. I think what it is that most people struggle because they overcomplicate things. And what I'm always trying to do is simplify things, and what I do to do that is use probability, and not so much probability but likelihood. You see, most traders have heard the word probability, and they are trying to put a number on something, but actually a much more interesting metric to use, and one that's far more useful for us, is likelihood. Now, likelihood's related to probability, but it's not quite the same. So, yeah.
What is the difference? What is the difference between a likelihood event and a probable event?
Well, a probability, I think the easiest way to describe it is, we'll just use a coin toss. If you get 6 out of 10, if you get 6 out of 10, if you toss a coin 10 times and you get 6 heads, then because a coin toss, it's a binomial distribution. So basically, you can use something like Pascal's triangle to give you the probability. So, natural fact, on a fair coin toss, the probability of getting 6 out of 10 is 21%.
Okay.
So when you have a probability, that probability is a fixed number. So if you have to make 10 predictions, if you toss a coin 10 times, you're going to have 11 different predictions ranging from 0 to 10. You're either going to be all wrong or all right, or somewhere in the middle.
Okay.
Now the problem with probability in trading is you can't compare it to anything. So the key with likelihoods is that you can compare the situation. So the easiest way to describe it is with probability, the idea or the hypothesis is fixed to the data. Okay. Whereas with likelihood, the data's fixed and the ideas shift. So what you can do is you can I mean, if you, to start with, without wasting too much time on it, if you think of a standard inferential statistical test, you have an idea. Well, you don't test that idea. You test it against the commonly accepted idea or the null hypothesis.
Right.
And then from there, you can't prove the null. You can only, the best it can do is get rejected, and therefore your idea becomes the new null hypothesis, and that's insane. So it also takes too long, and there's a much simpler way of doing it, and that's what I show people how to do. And it starts with asking questions about the market. So, for example, going back to our coin toss,
Yes.
if you have 6 out of 10 heads, and we say, okay, well, our idea is that coin is fair, and we get to 21%. So, again, we get that answer from Pascal's triangle. So what we can do then is we can say, okay, let's say that that coin is weighted to, instead of a fair coin, 75%. And again, we can use Pascal's triangle, and it tells us that the probability of getting 6 out of 10 is 15%. Well, here's the power of using likelihoods. What we can say is, because the journey to get either 15% or 21% is exactly the same, we can cancel them out. And what we can simply do is divide the two percentages into each other. So 21 divided by 15 is 1.4. Well, so what? Well, so what means, if your idea is, if you're asking the question, is that coin fair? 1.4 on that data means that it's 40% more likely to be fair than unfair.
Wow.
And so if you
cool?
use that,
Yeah.
it's that cool and that simple. So
Yeah, that's
the key-
cool, man. I got it, right.
Okay.
You know,
so
I
the
love
key-
numbers and expected value and all that.
Right,
ties
and you
into-
can set up a lot of those in the marketplace, right? I mean, because, like, well, even just this morning, this morning, these bonds were going topside beyond belief, and the Dow futures are up 120. It's like, man, why are you going hot topside? It's like, so in my head, I was setting up divergence there, like, okay, man, something's going to give here, but it's interesting, okay.
Sure. So to take that further, I look for asymmetric bets. And what I try and do is boil it down to asking simple questions about that market and coming up with a number and putting a number on it. And then it's just risk management and, who knows where it's going, but you just do your risk management, do your money management, and away you go. You put on a
risk
bet.
management. Let's get into that next segment.
You
all right?
stay right
Perfect.
there, folks, because we know where it's going. We're going to be coming right back with our man, Mr. John Jameson. This is Tommy O'Brien. Dow Industrials right now up 112. NASDAQ is up 3. NASDAQ's giving it up big time. S&Ps are up 7.5. We're going to be right back, folks.
Welcome back, folks. Tom and Tommy O'Brien. We're joined with John Jameson, and we're talking risk management. We're talking markets. So, John, let's dive into the cryptocurrencies a little bit, because we talked about this a lot. I know you've been trading that, and you and Larry are going to team up. You're going to be doing a workshop for subscribers. You're going to pick a date, probably sometime later this month. So tell us a little bit about what you've been doing trading cryptocurrencies. I know we've talked about it, but for listeners, tell us a little bit about what you have going on.
Well, sure. As I mentioned earlier, what I'm trying to do, the whole point of it is to try and find asymmetric risk and great bets. So on the 14th of September, 15th of September, Bitcoin lost 40% of its value.
Sure.
So if you look at that, and you look at the volume of Bitcoin traded, I know it's only tick volume from the provider that I use, but again, it was in the 500 or 600%, absolutely huge turnover. So the question I asked at the end of that day is this the end of Bitcoin? It's just as simple as that. And so using the techniques that we just talked about with probability, asking the right questions or asking certain questions or coming up with hypotheses and then assigning a probability to them, I came to the conclusion pretty quickly that no, it wasn't the end of Bitcoin. And so the likelihood of it taking out the highs were greater than that of taking out the lows. So you buy some Bitcoin. So how did I come to that conclusion? And it might sound like I get everything right, but obviously you don't get it right all the time. This one worked out. But how did I get to that conclusion? Well, I simply said, how rare is Bitcoin?
Yeah, that's a good one.
Yeah. So, is it rare?
Yeah.
Well, there are 20. I'm sure most of your listeners or some of your listeners will know that there are only ever going to be 21 million Bitcoins. And that to me seems fairly rare. So we were talking about likelihoods before. So 21 million means nothing unless you compare it to something. So let's compare it to another rare asset class, art. So imagine you were in the East Village in 1981 and you were out with some friends. You got invited back later on for drinks, and you discovered that in the house there was your friend was renting out a basement to a then completely unknown artist who a year ago was selling work on the street for $50. So anyway, you have a look at this art, you love it, and you decide to buy it. Just an impulse buy, and you pay what you think is a crazy price then of $1,500. So anyway, a few years go by. That's 1981. So in 1984, you are seeing in the news that this artist is friends with Andy Warhol, and you decide to go to Sotheby's, of course, to get the art valued, and you discover that your art's now worth $20,000. So you're pretty pleased with yourself, and you get it sold. So you've just made 1,233% profit in 4 years.
And that's in 1984 dollars, 20 grand.
In 1984 dollars, which is awesome. So you're feeling pretty pleased with yourself. Anyway, time goes by, and of course you know what happened to this particular artist. But in 2015, your particular work of art came back to market. So you got yourself into the back room of the night auction in New York at Sotheby's, and you watched in dismay what that painting fetched. So $20,000 in 1985. What do you think it went for in 2015?
I already know. You guess.
What? 2 million?
Well, that's a great guess. How about 65 million?
Oh my God. Oh,
So anyway,
this
is a real deal,
now,
right?
Yeah. Now you want to jump off a roof because maybe it wasn't a great decision to sell it back then. But here's the key. This is a piece of canvas and oil paint, and it's rare. Okay.
Yeah.
Now it can't be reproduced because the artist in fact died in 1988.
Okay.
And so you go again to you notice that the same piece of artwork comes up for sale again 18 months later. So you get yourself over to Sotheby's again, this time sneakingly hoping that the person who pays 65 million for it's gonna not work.
Of course, right? Yeah.
So you sit there in dismay as that painting sells again, this time for 110 million US dollars.
Wow.
We got to get into some art, man.
So the artist I'm talking about is Jean-Michel Basquiat, and what I'm trying to say is that you come up with ideas about investments, and one of the things is you need to compare it to other asset classes.
Right.
So there are 3 asset classes that traditionally maintains wealth over generations, and that is property or land, gold, and art.
Yep.
So
That's it. I'm not selling any more land.
Right?
I'm done.
so my point is that how high is high?
Yeah.
And so let's bring that back to Bitcoin. If you look at and use standard technical analysis on an arithmetic scale, it's bonkers. You completely in buying a parabolic.
Yeah. How do you chart something that's straight up? Right. Sure.
How do you deal with that exactly? Now, sure, you can turn it into log mode and all the rest of it, but still. So I found it much more efficient to just simply ask the question: is the likelihood of this going up more than the likelihood of it going down, and what's my risk if I'm wrong? So with that all factored in, the 2 questions I asked is this: very simply, not even very, very simply. Is it rare? Yes. How rare? Well, at current prices, Bitcoin's market cap at the time I purchased mine was under about 86 billion. So that sounds like a lot until you compare it to Apple.
Yeah, right. So, it's nothing. Right.
It's one man's wealth in this country, Mark Zuckerberg, to put things in, which is right, yeah.
Exactly. So then, how many Apple shares are there out there? Well, there's around about 5.1 billion. Against 21 million. Against 21 million bitcoins.
Sure. And they can make more shares any day they want.
Right.
Right. Right.
Now, there is an argument, and I'll come back to that in a second. It's called hard forking, but just let me get back to it in 1 second.
Yeah.
So the other bit of information that I've been reading about this summer, in August in fact, is that they're going to start imminently offering futures and options on Bitcoin.
Yes.
And that was the clincher.
Right.
So as soon as you get professional firms trading in Bitcoin, they're going to be selling the vol. They're going to be selling the implied volatility on that contract all day.
Right.
And by my way of thinking, that means that that's going to control the prices to the downside, because if they're selling one standard deviation or at the money puts, there is no way in this world that they're going to let that. They're going to lose money on that without buying to support the
There
position.
becomes the wall of support right there.
Right.
Yeah.
Right. And that wall of
Exactly.
support is going to be on a monthly basis.
Right.
Yeah,
Daily. Right. Yeah. Exactly.
Right.
Exactly. So with those simple heuristics in place, you take your position, and your risk is set, and that's all there is. Well, when I say that's all there is to it, that's it.
No,
So,
and, I just liked how you were talking about, and Larry's, you're breaking things down to 5-minute trading days and the volatility that's involved in there. So I encourage people, man. I've had a couple good hour-long conversations with John myself. Larry's talked him up, but he's going to be back this month. It's November already, so sign up for Fibonacci, get in there. John, we appreciate it, man. We look forward to having you back on the show.
Thanks so
great.
much,
If
John.
anyone wants to get in contact with me, by the way, you can go to johnjameson.net, and I've got a contact number on there if anyone wants to talk more about what I've been talking about.
Awesome. We'll plug it right after the break as well. Thanks, John.
Thanks very much. Great to be here.
Thank you.
Thank
Stay
you.
right here, folks. Welcome back, folks. Dow right now is up 119. Nasdaq's up 7. S&Ps are up 9.5. And man, Mr. John Jameson, give that website out.
Yeah, so it is johnjameson.net. Jameson, Jameson, johnjameson.net. And he does a lot of great consulting work. What were you going to say? The art history?
The art history. So inside his bio, folks, is pretty cool. John studied art history and business at Sotheby's Institute in London. Yeah, man. Art history. Holy cow.
You got to love it, man.
That's quite a story.
Gotta love it.